of strategic compensation management is the use of incentive plans, also called variable pay programs. Variable pay is tying pay to some measure of individual, group, or organizational performance. Variable pay programs consist of bonuses, incentive, or recognition for good work. Incentive pay plans establish a performance threshold that an employee or group of employees must achieve to qualify for incentive payments. It creates shared commitment through the belief that every individual contributes to organizational performance and success. Contemporary arguments for incentive plans focus on linking compensation rewards for individuals and groups to organizational goals. The incentive plan purposes is to encourage employees to assume ownership of their job, thereby improving their effort and overall job performance, to motivate employees to expend more effort than under hourly and/or seniority-based compensation systems, and lastly, to support a compensation strategy to attract and retain top-performing employees. For proof of incentive plan effectiveness, there is evidence of a relationship between incentive plans and improved organizational performance. Compensation specialist Joanne Semmer notes the following as characteristics of a successful incentive plans. First is to identify the importance of organizational metrics that encourage employees' behavior. Second is to involve the employees. Incentive programs should seem fair to the employees. Third is to find the right incentive payout. Payout formulas should be simple and understandable. And lastly is to establish a clear link between the performance and payout. Next is setting the performance measure. This is especially the case when the assessments are used to distribute rewards. You will need to be able to distinguish between individual contributions and those made by a group. You will need to be able to avoid biases based on who you like and dislike, different personalities and political agendas. At the group level, you will need to distinguish how much one group contributed over another group, even if the work they do is highly interdependent. In summary, measuring in a way that makes employees feel like they are being treated unfairly can lead to serious problems.
For my introduction, one word, flexibility, describes the design of individual incentive plans. For example, technology, job tasks and duties, and organization goals, such as us being low-cost producer, impact the organization choice of incentive pay programs. Incentive payments may be determined by the number of units produced, achievement of specific performance goal, or productivity improvement in the organization as a whole. Straight piece work and differential piece rate. Under straight piece work, employees receive a certain rate for each unit produced. Their compensation is determined by the number of units they produce during a pay period. Under a differential piece rate, employees whose production exceeds the standard output receive a higher rate for all of their work than the rate paid to those who do not exceed the standard. Piece work, the drawbacks. One of the most significant weaknesses of piece work as well as of other incentive plan based on individual effort is that it may not always be an effective motivator. Also, jobs in which individual contributions are difficult to distinguish or measure, or in which the workers is mechanized to the point that the employee exercises very little control over output may be unsuited to piecework. Another common incentive technique is the standard hour plan, which sets incentive rate on the basis of predetermined standard time for completing a job. If employee finish the work is less than the expected time, the pay is still based on the standard time for the job multiplied by their hours rate. Bonus and support bonus. A bonus is an incentive payment given to employees beyond their normal base wage. It is usually given at the end of the year and does not become part of base pay. Bonuses can be a powerful tool to increase future performance. For example, a study on bonuses versus actual pay rise showed that improving one pay through merit increase by 1% will increase future performance by 2%. However, if the same money was applied to pay for performance bonuses, the employee's performance increased by 50%. A spot bonus, as the name implies, is given on the spot, normally for some employees' effort not directly tied to an established performance standard. Lawrence Sagens, compensation expert with Olsen Wyatt Worldwide, notes, I think spot bonuses are one of the most underutilized form of rewards, given how well employees respond to them. Merit pay and merit guidelines. A merit pay program, merit grants, link an increase in base pay to how successful an employee performs his or her job. Unlike bonuses, once merit increase are given, they become part of base pay, regardless of future performance. Merit rise can serve to motivate if employees perceive the rise to be related to their performance required to target. With low salary budgets, organizations wishing to reward top performance will be required to distribute a large portion of the compensation budget to this individual. A meaningful merit increase will catch the attention of top performance while sending a signal to poor performing employees. Guidelines for awarding merit rise that are tied to performance objectives. Problem with merit rise. Money for merit increase may be inadequate to satisfactorily rise all employees' base pay. Manager may have no guidance in how to define and measure performance. They may be regarding merit reward criteria. Employees may not believe that their compensation is tied to effort and performance. They may be unable to differentiate between merit pay and other types of pay increase. Employees and their managers may hold different view of the factors that contribute to job success. Merit pay plan may create feeling of pain. No easy solution to this problem. Organizations using a true merit pay plan often base the percentage pay rise on merit guidelines tied to performance appraisal. Incentive award often used to recognize productivity gains, special contribution or achievement, and service to the organization. Employees feel appreciated when employers tie award to performance and deliver awards in a timely, sincere, and specific ways. Non-cash incentive awards are most effective as motivators when the award is combined with a meaningful employee or grant.
I will continue the presentation on the sale incentive plan. Enthusiasm and encouragement required in most type of sale work demand that sale employee be highly motivated. This incentive plan must provide a source of motivation that will elicit cooperation and trust. Next, the unique needs of sale incentive plan. Incentive system for sale people are complicated by the wide difference in the type of sale job. This range from department store clerks who rely on customer purchases to industrial sale people who are provide consultation and other highly technical services. Then, performance standards for sale employees are difficult to develop, but if done right, can motivate employees to improve performance. But last but not least, gamification is one way to provide fun way to motivate sales team. For example, when a company is game to have employee and team compete with one another or even team outside of the office, they tend to see improvement in performance. Now we go to the next part, which is type of sale incentive plan. Okay, compensation plan for sale employee may consist of a straight salary plan, a straight commission plan, and a combination salary and commission plan, or a sale plus bonus plan. Specifically, there are three types of sale incentive plan, which are straight salary plan, straight commission plan, and salary and commission combination plan. Firstly, straight salary plan is a compensation plan that permits sale people to be paid for performing various duties that are not reflected immediately in their sales volume. It enables them to devote more time to providing service and building up the goodwill of customers without jeopardizing their account. So, we know that the advantages of straight salary plan are encourage building customer relationship and provide compensation during period of poor sale. Then the principal limitation of the straight salary plan is that it may not motivate sale people to exert sufficient effort in maximizing their sale volume. Next, straight commission plan is a compensation plan based on the percentage of sale, provide maximum incentive, and is easy to compute and understand. The advantages of straight commission plan are encourage aggressive selling, which might be needed in highly competitive industries. Also, sale people might be allowed a salary draw. The term draw in this sentence is defined as a cash advance that must be paid back as commission are earned. However, the straight commission plan is limited by the following disadvantages, which are: first, sale people will stress high price product. Second, customer service after the sale is likely to be neglected. Third, earnings tend to fluctuate widely between good and poor period of business, and turnover of trained sale employees tend to increase in poor period. Fourth, sale people are tempted to grant price concession. Last but not least, combined salary and commission plan is the most widely used sale incentive program and also known as a compensation plan that includes a straight salary and a commission. The first advantage is as most of the advantages of both the straight salary and the straight commission form of compensation. Second, a salary plus incentive compensation plan offers greater design flexibility and can therefore be more readily set up to help maximize company profit. Third, this plan can develop the most favorable ratio of selling expense to sale. Lastly, fourth, the field sales force can be motivated to achieve specific company marketing objectives in addition to sale volume. In addition, another type of sale incentive plan is a salary plus bonus plan, which is a compensation plan that pays a salary plus a bonus achieved by reaching target sale goal. Under salary plus bonus plan, the payout can be paid on a monthly, quarterly, or yearly schedule based on the sale people achieving target sale goal, such as number of sale call made, account servicing, or quality of sale.
Team incentive plan, compensation plans where all team members receive an incentive bonus payment when production or service standards are met or exceeded. How to establish team incentive payment? First, set performance measure upon which incentive payment are based. Second, determine the size of incentive bonus. Third, create a payout formula and fully explain to employees how payout will be distributed. Advantages and disadvantages. Advantages are team incentive support, group planning, and problem solving, thereby building a team culture. Second, the contributions of individual employees depend on group cooperation. Third, team incentive can broaden the scope of the contribution that employees are motivated to make. Fourth, team bonus tend to reduce employee jealousy and conflicts over time or lose individual standard. Lastly, team incentives encourage cross-training and acquiring of new interpersonal competency. Disadvantages are individual team members may perceive that their effort contribute little to team success or to the attainment of the incentive bonus. Second, intergroup social problems with pressure to limit performance and free ride effect may arise. Lastly, complex payout formulas can be difficult for team members to understand. Is gain sharing incentive plans. Programs under which both employees and organizations share the financial gains according to a predetermined formula that reflects improved productivity and profitability. Increase in productivity is gained when greater output is obtained with less or equal input. Equal production is obtained with less input. Scale-on plan is rewards come from employee participation in improving productivity and reducing costs. Input share is gain sharing based on increase in productivity of extended hour output of work teams. This figure shows the scale-on plan suggestion process. Types of long-term incentive plans are stock options, stock appreciation, stock purchase, phantom stock, restricted stock, performance units, and performance share.
Profit sharing is any procedure by which an employer pays or makes available to all regular employees, in addition to their base pay, current or deferred sums, based upon the profits of the enterprise. However, there were a few weaknesses of profit sharing. The profit shared with employees may be the result of eventual speculation, climatic factors, economic conditions, national emergencies, or other factors over which employees have no control. Conversely, losses may occur during years when employee contributions have been at the maximum. The fact that profit sharing payments are made only once a year or deferred until retirement may reduce their motivational value. If a plan fails to pay off for several years in a row, this can have an adverse effect on productivity and employee morale. Stock options granted the employees the right to purchase a specific number of shares of the company's stock at the guaranteed price during the designated time period. The value of an option is subject to stock market conditions at the time that option is exercised. Employees Ownership Plans, or ESOP, is a stock plan in which an organization contributes shares of its stock to an established trust or the purpose of stock purchases by its employees. An ESOP is an employee established trust that qualifies as a tax-exempt employee trust under Section 401 (a) of the Internal Revenue Code. Under an ESOP, employees do not actually buy shares. Instead, the company funded its own shares to the plan, funded cash to buy its own stock, often from an existing owner, or most commonly has the plan borrow money to buy stock, with the company repaying the loan. The advantages of ESOP are it is encouraged by favorable federal income tax provisions. Employers use ESOPs to provide retirement benefits for their employees. Favorable tax incentives permit a portion of earnings to be excluded from taxation if that portion is assigned to employees in the form of shares of stock. Employees can therefore provide retirement benefits for their employees at relatively low cost because stock contributions are in effect subsidized by the federal government. ESOPs can also increase employees' pride of ownership of the organization, providing an incentive for them to increase productivity and help the organization prosper and grow. However, the downside of ESOP is the employees do not have the alternative of disposing of their stock on the open market. Thus, when the large organizations suffer financial difficulties and the value of the company's stock falls, so does the value of the employee's retirement plan. ESOP contributions are not guaranteed by the federal established Pension Benefit Guarantee Corporation, a major drawback to employees should their employer face serious financial setback or closure.
I would like to present about the professional employees and executive incentive plans. Managerial and executive incentive. First is bonus and merit increase, double track wage system, performance incentive bonus, profit sharing and stock ownership, executive perks. Executive compensation plans consist of 5 basic components. First, base salary. Second, short-term incentive or bonus. Third, long-term incentive or stock plans. 5, benefits, and 5, perks. Executive base salary. It is represent between 30 and 40% of total annual compensation. Analysis of executive salaries shows that the largest of executive pay is received in long-time incentive, reward, and bonus. The level of competitive salary in the job market exerts the greatest influence on executive base salaries. Next, about the executive short-term incentive. Annual bonus represents the main element of executive short-term incentive. Most organizations pay their short-term incentive bonus in cash. Incentive bonus for executive should be based on the contribution individual to the organization. Incentive bonus may be based on the percentage of the company's total profits or a percentage of profits in excess of a specific return on stockholders' investment. In other instances, the payments may be tied to an annual profit plan whereby the amount is determined by the extent to which an agreed upon profit level is exceeded. Payment also based on performance rating or the achievement of specific objects established with the agreement of executive and the board of directors. In a continuing effort to monitor the pulse of the marketplace, more organizations are applying operational yardsticks to the traditional financial gauge when computing executive pay. It is called balanced scorecards. These yardsticks may measure things such as customer satisfaction, the ability to innovate, or product or service leadership. Additionally, stock options can serve to retain key executive personnel. And exercising the options is linked to a specific vesting period, perhaps 2 or 4 years. This type of incentive is called golden handcuffs. Let's slide about the executive perks. Perks are non-monetary rewards given to executives. Perks are a means to demonstrating the executive importance to the organization. The status that comes with perks, both inside and outside the organization, show a pecking order and conveys authority. Corporate executives may simply consider perks a badge of merit. Perks can also provide tax or tax saving to executives because some are not taxed as income. Okay, last about the criticism of executive incentive plans. Incentive payments are excessive compared with return to stockholders. The time period for judging and rewarding performance are too short. Next, the quarterly earning growing is emphasized at the expense of research and development. Next, the emphasis is placed upon equaling or exceeding executive salary survey average. Benefits do not relate closely to individual performance. So that's all from us. Thank you.